everyone, and welcome to the Business Fundamentals Specialist video series. Today we'll be going over the basics of accounting in Accounting 101. So first, what is accounting? According to your business text, accounting is the process of systematically collecting, analyzing, and reporting financial information. Accounting is used to determine the company's health and financial well-being, and can also answer questions such as to the amount of profit made last year, how much taxes are owed, and how much cash we have on hand, among others. Some accounting basics that we'll cover in this slide, or in this presentation rather, are that there are two different types of accounting, managerial and financial. There are three main financial statements used in accounting: the balance sheet, the income statement, and the cash flow statement. And the accounting equation is used to calculate figures and to check balances for the financial statements above. So first, managerial versus financial accounting. Managerial accounting, as the name suggests, is meant to report internal sources, the financial going-ons inside the company. So it provides internal decision makers with the needed information to essentially make more well-informed decisions, which, as we've gone over in earlier chapters of the text, a more well-informed decision has less risk attached to it. And the generation of financial statements for external recipients are created through financial accounting. These are usually meant to be used for external sources, as I mentioned earlier, usually to report the financial health of the business to stockholders, analysts, lenders, etc. And the accounting equation is used to really help generate the financial statements that are sent to external recipients. If you've taken any sort of entry-level accounting, you've probably seen this equation before. Assets equal liabilities plus owner's equity. As can be seen in the equation, the company's assets are equal to the owner's equity less liables, as often liabilities are negative amounts as they represent what the company owes. This equation is used to determine the company's assets to really assess where the company is in terms of its liabilities. The equation also helps to show how each aspect of the company affects the others. This equation can be seen outlined in the balance sheet, which we'll go over shortly here. And assets, which are the company's resources that have value, such as cash, equipment, inventory, and real estate, are listed on the balance sheet and are usually listed from liquid to least liquid, liquidity being the ease in which an asset can be converted into cash. So obviously cash is the most liquid, so it's first listed. Current assets are ones that can be turned into cash the easiest as well. So the company's resources are its assets. From that, you would subtract liabilities, which are debts owed. These are obligations the company has to pay or provide goods or services at a later date to other individuals, lenders, etc. And that equals the owner's equity, which are the net assets or the difference between assets and liabilities. I read a great sort of analogy of this term, and essentially owner's equity would be what's left over if you sold the company. That's the worth of what the company is if you had to sell. So, you get rid of all the assets, but you'd also get rid of the liabilities, and you would have your net profit there. The balance sheet is essentially the summary of the accounting equation that we just went over. These are created for each specific accounting period and must demonstrate that assets truly do equal liabilities plus owner's equity. And this is usually a source of information when looking for the total assets, liabilities, and owner's equity of a company. The balance sheet contains the following information, which I lightly touched on in the previous slide: current assets, fixed assets, intangible assets, current liabilities, long-term liabilities, and stockholders' equity. These figures are then used to calculate total owner's equity and total liabilities and owner's equity. Assets on the balance sheet, again, are listed from most liquid to least liquid. Fixed assets are listed after current assets, which are the most liquid, and fixed assets are essentially assets that would be held or used for a period longer than a year. Depreciation is often deducted from these, which is essentially the process of apportioning the cost of a fixed asset over its useful life, the period in which it will be used. Then we list current liabilities, as well as other liabilities that are created through the company. And current liabilities are essentially debts that will be repaid in a year or less. For example, if you've purchased merchandise from a supplier on credit, that is considered a long-term or a current liability. A long-term liability, which is also listed here, are debts that need not be repaid within 1 year. They can be mortgages, for example, for store equipment or for a store location itself, and these are generally paid over many years. Then we have the owner's and stockholders' equity. And for a sole proprietorship or a partnership, the owner's equity is shown as the difference between assets and liabilities. Then retained earnings are listed here as the portion of a business's profit that is not distributed to its shareholders or stockholders. Then we move on to the income statement. The income statement shows the profit or loss at the end of an accounting period. It can also be referred to as the earnings statement or the statement of income and expenses, and is a summary of a firm's revenues and expenses during a specified accounting period, which is normally set by the company and can be anywhere from 1 month, 3 months, 6 months, or a year. Revenues, then, as included in the terms to know here for the income statement, are the dollar amounts earned by a firm by selling goods, providing services, or performing business activities. Gross sales are the total amount of all goods and services sold during the accounting period. From this amount, companies deduct any returns, discounts, or sales allowances on damaged goods. What's left then are the firm's net sales, which are the actual dollar amounts received by the firm for the goods and services it has provided. The cost of goods sold is the equation you see on the screen here. Beginning inventory plus net purchases minus ending inventory. A manufacturer of goods or services must include raw materials here, works in process, and direct manufacturing costs in this calculation. Gross profit is calculated by subtracting the cost of goods sold from net sales. Operating expenses are all of the costs other than the cost of goods sold. This can include selling expenses such as advertising, marketing, or PR, and other general costs. Net income is what is experienced when a company's revenues exceed expenses. And conversely, if expenses exceed revenues, it is then referred to as a net loss. The statement of cash flow. The SEC and Financial Accounting Standards Board thought that a cash flow statement was necessary, and it was required in 1987 for every publicly traded company to include in its annual report, in addition to the income statement and balance sheet. The cash flow statement is essentially what its name entails that it is, the statement of the movement of cash throughout the company's various activities. It reports and illustrates how the operating, investing, and financing activities of a company affect cash during a specific accounting period. So there are 3 areas of cash flow. Again, as I mentioned, operating, investing, and financing. Cash flow from operating activities essentially covers cash paid to suppliers, employees, interest, taxes, and other expenses, deducted from the amount of cash received from customers. Lastly, the interest and dividends received by the company are added to determine the total. Cash flow from investing is essentially the second section, which addresses cash flow from investments such as buying and selling property and other assets. And the cash flow from financing activities, the third section, covers the changes in debt obligation and owner's equity accounts. This includes loans and repayments, the sale and repurchase of the company's own stock, and cash dividends. As we've gone over, there are many reasons to use accounting, and they can be summed up in reporting and analyzing information. Accounting puts things into perspective, it helps to keep companies honest, and it allows you to compare your information and data with other companies that may be operating in the same industry. Accounting makes it so that companies can see where money is going, where their liquidity rests, and what their next moves could be if there are changes that need to be made. You can also compare the information from your own accounting activities and compare it with past periods to see your growth or decline. You can also calculate ratios like return on sales, return on owner's equity, earnings per share, and others such as the current ratio, which is current assets divided by current liabilities. Essentially, accounting keeps track of everything the company does and where it might be going in the future, as analysts and executives in the company can use this information to make decisions and to allocate funds as necessary. Accounting is pretty crucial for any company to have success. And while accounting may be boring and probably tedious to some, success of a company really relies on having great accounting in place and great accounting associates who can help you with your accounting needs and accounting analyzation. So this concludes our Accounting 101. If you have any questions, feel free to post them to the forum or email me at ashley@businesstraining.com. Take care.